Another day, another story. Debt plays a significant role in personal finance and business operations. When it comes to borrowing money, it's essential to understand the key distinctions between revolving and non-revolving debts. Both types have unique characteristics and can impact financial planning and budgeting differently. In this video, we will delve into the differences between revolving and non-revolving debts, providing examples to illustrate their practical implications. Revolving debts are credit arrangements that allow borrowers to access a predetermined line of credit repeatedly. Borrowers have the flexibility to borrow, repay, and borrow again as long as they stay within their credit limit. The outstanding balance revolves based on the borrower's credit usage and payment patterns. The most common examples of revolving debts include credit cards and lines of credit. Credit cards are a widely used form of revolving debt. They provide users with a revolving credit line, allowing them to make purchases up to a certain limit. The borrower can choose to pay the full balance each month or make minimum payments and carry forward the remaining balance, incurring interest charges. As long as the borrower stays within the credit limit, they can continue using the card for future purchases. Lines of credit are another form of revolving debt commonly offered by financial institutions. They provide borrowers with access to a predetermined credit limit. The borrower can withdraw funds as needed and repay the borrowed amount over time. Once repaid, the credit becomes available for future borrowing. This flexibility makes lines of credit suitable for managing short-term financial needs or unexpected expenses. Non-revolving debts, also known as installment debts, are loans where borrowers receive a lump sum amount that must be repaid in fixed installments over a specified period. Unlike revolving debts, once the borrowed amount is repaid, it cannot be borrowed again without going through a new loan application process. Common examples of non-revolving debts include mortgages, car loans, and personal loans. A mortgage is a long-term loan taken out to finance the purchase of a property, typically a home. Borrowers receive a lump sum amount and repay it over an extended period, often spanning several decades. The repayment is made through fixed monthly installments that include both principal and interest. Once the mortgage is fully repaid, the debt is considered closed, and the borrower owns the property outright. Car loans are another form of non-revolving debt used to finance the purchase of a vehicle. Borrowers receive a specific loan amount and repay it over a fixed term through regular installments. The interest rates and loan terms vary based on factors such as creditworthiness and the value of the vehicle. Once the loan is fully repaid, the borrower owns the car outright. Personal loans are unsecured loans that borrowers can use for various purposes, such as debt consolidation, home improvements, or financing a wedding. The loan amount is disbursed as a lump sum, and borrowers repay it over a fixed term through regular installments. Interest rates and repayment terms are determined by the lender based on the borrower's creditworthiness. Understanding the differences between revolving and non-revolving debts is crucial for effective financial management. Revolving debts, such as credit cards and lines of credit, provide ongoing access to credit within a specified limit. Non-revolving debts, such as mortgages, car loans, and personal loans, involve borrowing a lump sum and repaying it through fixed installments over a defined period. By being aware of these distinctions and considering their implications, individuals and businesses such as credit cards and lines of credit provide flexibility and convenience but can also lead to excessive debt if not managed properly. Non-revolving debts, such as student loans and mortgages, have a fixed repayment schedule and are typically used for specific purposes. Revolving debts allow borrowers to borrow and repay funds repeatedly, up to a certain credit limit. They offer flexibility because borrowers can choose to make minimum payments or pay off the full balance each month. However, the interest rates on revolving debts are often higher compared to non-revolving debts, and if the balance is not paid in full each month, interest charges can accumulate rapidly. Non-revolving debts, on the other hand, have a fixed repayment schedule, typically with equal monthly payments over a specified term. These debts are often used for larger purchases or long-term investments. Non-revolving debts usually have lower interest rates compared to revolving debts, making them more affordable in the long run. Effective financial management involves understanding the implications of both types of debt and making informed decisions based on personal financial goals and circumstances. It is important to consider factors such as interest rates, repayment terms, and the potential impact on credit scores when deciding between revolving and non-revolving debts. Revolving debts provide flexibility but can lead to high interest charges and excessive debt if not managed wisely, while non-revolving debts offer stability and lower interest rates but have a fixed repayment schedule. By understanding these differences, individuals can make informed decisions to effectively manage their finances and maintain a healthy financial situation. Thanks for watching.